We're going to kick off Money Moves, where we cover the New York venture cap and startup scene. It is part of our all-to-asset focus with hedge funds, private equity, real estate in the mix as well. We're going to start with a focus on gold because it is down nearly 10% today, clearly in a bear market. Just for context, in the past 5 years, there have been two other noticeable hurried moments, if you like, of selling. So September 2011, gold down around 20% in a short period. Investors focused on Europe's risks. You had unprecedented coordinated central bank action. July 2008, gold down 21%. That was right before Lehman collapsed and the credit crisis ensued. Our commodities reporter Alex Steele with us now with more from the newsroom. So Alex, given the last two times that gold dropped so quickly, how many people are wondering what's around the corner?
A lot, Deirdre. It's the question of the day, right? How do you find a bottom in a market that's gone up for 10 years? Well, George Giro of RBC says he has not seen anything like this in 4 decades of trading. Now, the panic really started on Friday. It was sort of a combination. The Fed members have been talking more forcefully about pulling back on QE, inflation not really materializing. Cyprus might sell its gold, and Goldman says to short the metal. So a quadruple whammy for the market. And our friends over at Bespoke crunched the numbers and found that actually since 1975 there have been 13 bear markets. Now, from the beginning of the bear market to the bear market low, the average decline is over 14%. So if that trend continues, it would push gold down to $12.81 an ounce. And the theory among many of my sources is that there are big institutions selling, and of course that big move then trigger sell stops where traders are forced to sell to protect profits. Now, some are anticipating some kind of short covering bounce after these big 2 down days, but that doesn't mean this gold route is over, Deirdre.
Okay, Alex, certainly not. And we know there's a lot of investors, various kinds of investors that have been caught out. John Paulson is one that comes to mind. I mean, he's lost something like $1 billion in the past 24 hours alone.
Well, there you go. You totally said it. It was a pretty ugly 2 days for John Paulson. Paulson has personally lost about $1.5 billion over the past 2 sessions on his gold bet. Now, he has about $9.5 billion invested across his hedge funds, and 85% is invested in gold share classes. Now, Paulson, remember, had told investors last year that his $700 million gold fund would beat his other strategies over 5 years, as gold profited as an inflation hedge. And he actually is sticking to that gold commitment. John Reed, partner and gold strategist at Paulson & Co., actually put out a statement that read, quote, "The recent decline in gold prices has not changed our immediate to long-term thesis. While gold can be volatile in the short term and is going through one of its periodic adjustments, we believe the long-term trend of increasing demand for gold in lieu of paper is intact," Deirdre, so not turned off by that $1.5 billion loss so far.
All right, Alex, thank you very much. Our commodities guru, Alex Steele, joining us there from the newsroom. Well, our first guest has suggested using gold as an inflation hedge for years. Jim Grant is with us, friend of the show, editor of Grant's Interest Rate Observer, our economics editor. Michael McKee, not wanting to miss out on the fun of talking about gold and inflation as well. Jim, we'll start with you. What does this mean that gold has, in fact, entered a bear market? Does it signal a crisis?
Well, I think the only thing it truly means is that people do hate this stuff. The rest of it is surmise. Now, there's a distinction to be drawn between a panic in which the only cause is really the structure of the marketplace, and a crash in which the collapsing asset class portends something about the future. 1987, the stocks crashed down, what, 25% or so in 1 day.
Right.
It signified nothing except that the market was poorly structured, just with respect to portfolio insurance. The bond market crashed in 1994, but still intact was a long-term decline in interest rates. It seems to me that what is intact at the moment is the determination of central banks to print their way out of trouble, which is terrifically bullish for gold over the long term. So I remain bullish, though chagrined.
Okay, bullish, though chagrined. Michael, how do you see this as fitting in with what we've all been talking about, the central banks doing these kind of unprecedented help packages and basically, as Jim just said, printing money.
Well, the latest economic fundamentals suggest that the economy is still weak. The Fed is going to remain in the game. And even those who were talking about scaling back on QE, doing some tapering, aren't talking about it until the middle of the year or later. So it doesn't seem like there's a real connection between that and what's happening to the gold price right now, nor does it seem to be a connection to inflation, because at this point, inflation is relatively stable. We're likely to see in the CPI tomorrow a drop driven by oil prices, but that's been very volatile. If you take oil prices out, inflation's been basically stable over the last year or so, whereas gold prices have not. They've been coming down since October.
Deirdre, I would say that gold is not so much a hedge against inflation as it is against monetary disorder.
I know you've called it not quite the fear trade before. You said it's the fatigue trade.
Well, it seems to me it's an investment in historical destiny, the destiny of money-spending central banks to debase those currencies. So what we have today is are poorly capitalized and poorly managed and cartelized mega financial institutions the world over. We have in China a regime that is creating credit at the annual rate of 47%, and we have in Japan a central bank that has announced that it will create yen at the equivalent of, in GDP terms, of like $190 billion a month if it were the United States. We do $85 billion a month. They're doing the equivalent in their economy of 190. And in this backdrop, it seems to me that to be bearish on gold, you know, it might be the fact of trade. It might be the trade. But, well, to be bearish on it, you really have to believe that the central bankers are for once going to figure it out and do something in time.
But your argument would make more sense if gold prices were crashing up at this kind of rate. They're going down. It doesn't seem like there's a lot of fear, certainly among institutional investors, that there is this monetary disorder out there.
Well, the institutional investing community was utterly sanguine in the summer of 2007. You know, as Mr. Morgan himself said, Michael, markets fluctuate. And this is, for the gold bull, it's vexing and trying and dispiriting. I felt so much smarter and richer last week than I do this week, Deirdre.
All right, well, we're going to time your appearance better, Jim. But I want to ask, I mean, because you mentioned China, you mentioned Asia, and a lot of people, at least if you were on Twitter or you were blogging, you saw a lot of people when gold first started to drop, Michael, talking about the fact that China's growth came in a little bit under what was expected, but it's still 7.7% growth.
It's still 7.7% growth, and really it's within the range of what people were expecting. It's a new normal growth rate there. We're not going to see the double digits, but gold doesn't have anything to do with the rate of growth in China. It may have something to do with the rate of credit creation, but right now China's not creating the kind of reserves that changed currency values that led to people holding more gold.
But the reserves are reaccelerating to the upside, so China...
But they haven't, though. The reserves at this point are staying flat.
They're going a lot. It's
like,
true.
Yeah, well, it's true that we don't have an exceptionally clear read, do we, out of the economic data that comes out of China?
No, nor do the Chinese, except the ones who make it up.
Okay, well, fair enough.
Make them up.
Make them up.
Data are plural.
So you still say, listen, gold is still an inflation hedge, and one day this will come.
Well, it is a hedge against the seeming inevitability, to me, the inevitability of the collapse of what one might call the PhD standard. We had the gold standard. We've had variants on that. And now we have the purely discretionary regime of our over-credentialed central bankers improvising, as the chairman of the Fed said himself last summer, learning by doing. That is the standard in place. And I say that it is not one for the ages, and that the successor standard will have something to do with objective and permanent value.
All right, here, Jim Grant, you are staying with us. Michael McKee is going to move on. Thanks, Michael. In the meantime, our economics editor joining us there. We just want to show you stocks as well. It's not just gold selling off. If you look, the Dow, the S&P 500, the NASDAQ, lower across the board. Matt Miller right now is in our newsroom at our data center with more details. Matt.
Yeah, we're seeing a big sell-off here, Deirdre, in equities as well. And the S&P, interesting, coming down 1562 and change now. So down below the October 2007 highs that we were so happy to break through just a couple of weeks ago. The commodities producers obviously are one of the big heavyweights that are weighing on the indexes. Anything having to do with the underlying commodities, which is falling, is down itself, and they're getting downgrades on the stocks. Citi, for example, coming out and downgrading Freeport McMoran. Copper falling. Freeport down 8%. Iron ore falling. Cliffs Natural Resources down 6.8%. Gold obviously taking a huge dip. So Newmont Mining down 6%. Also, any of the companies that help those guys get what they need out of the ground are down. Caterpillar, if you want earth-moving equipment, they make it down 3%. Fluor, the logistics, if you need to put together a team to do that, they're down 8%. General Electric, if you need to power those operations, down 2%. And the energy players themselves, really especially a drag on the Dow Jones Industrial Index. The Chevron and Exxons of the world falling, but they're a huge drop on the Dow. Masco, a big weight on the S&P, down 7.4%. Citi itself is one of the big gainers today after profit rose 30%. $3.8 billion is what the bank made in the quarter, and the stock is up 1.5%. And then Sprint. On the trading floors around the country, people were cheering today as this stock jumped 15%. Dish coming in with an unsolicited buy. $25.5 billion is the value of that, cash and stock, and a big boost to the stock and a big boost to anybody who wants to trade arbitrage on that. Deirdre, back to you.
Matt, thank you very much. Matt Miller joining us there from the newsroom with the very latest on the stocks and their declines across the board. Well, after this quick break, the big deal of the day, Dish Network has a $25 billion bid for Sprint Nextel, rather. It tops the recent competitor's bid. More on the likely next steps in just a few minutes. Plus, if you are sick of just sending plain old texts, we're going to tell you about a new app that is trying to revolutionize how you communicate. It's called Message Me. You can send photos, videos, even a little few bars from your favorite song. The CEO will join us.
First, Bloomberg.
Welcome back to Money Moves on Bloomberg Television and streaming all day long on your iPad and at Bloomberg.com. A special welcome today to all our new viewers on DirecTV watching our HD channel. Well, Dish Network is a satellite TV company trying to get into the wireless business. It put in a bid to buy Sprint Nextel for more than $25 billion. So that tops a bid from SoftBank for about $20 billion. Our deals reporter, Christina Leshy, with me now. She's been following this story. So, Christina, this isn't too surprising, right? We've been talking about Sprint Nextel and all the possibilities, but here we have a bid topping another one.
Right, and, you know, the deal didn't leak, so it's surprising in that sense. But other than that, we know that Dish chairman Charlie Ergen has been on the hunt for deals, and he's been busting up other people's deals. So we've seen him kind of do this before with, you know, Sprint has a deal to buy Clearwire. He's trying to buy Clearwire. So he knows that the future of his company really rests on not being able just to do satellite television, but data on mobile is going to be huge, and he wants to be a part of it in a big way.
Okay, so as we said, this is a bigger, if you just look at face value, $25 billion is more than $20 billion, but there's some other details in there.
Exactly. So both deals are a mix of cash and stock for about 70% of the company, and what Dish is saying is that their bid is actually higher, that shareholders will get more cash, but also the stock component, they're arguing, is going to be worth more, because what shareholders will get, that extra 30%, is a combined company, Dish plus Sprint, versus what SoftBank is offering, which is just a residual of 30% of Sprint, which they would say is worth less than a combined company.
So, Christina, is there a guess out there? I mean, are we going to see a bidding war?
Well, look, both sides are going to have their say. What Dish will say is, look, we have spectrum, which is very, very valuable and can be plugged into perhaps Sprint's networks. So that's a very obvious synergy. Also, there's cost savings with the combination of the two. What SoftBank will say is, we are financially very robust and sound, and Sprint needs a lot of cash to actually update its networks. And when you're talking about a combination of Dish and Sprint, you're going to have a lot of extra debt on that company, and the question becomes, can you finance the build-out of that network when you have a combined company? So the answer to the question is probably we will see a bidding war,
right,
but it's also going to be more than just dollars and cents. The stock is certainly trading like there's going to be a bidding war, but investors will have to look at this deal very holistically.
Okay, Christina, thanks as always. Our deals reporter, Christina Leshy, joining me there with, well, some possibilities for Sprint Nextel's fate. When we come back, more with Jim Grant, editor and founder of Grant's Interest Rate Observer. More on how to invest for, as he sees it, an inflation-filled future. We're back in just 2 minutes. Jim Grant is back with us. He is the editor of Grant's Interest Rate Observer, of course, and we are focused on inflation. Hard not to be when you see gold prices where they are. On average, 2% over the past 5 years. But we just want to read a little bit from a blog posting. Paul Krugman writing earlier this morning, the gold bug inflationista view, I think he made that word up, but that's all right, of the world, says that we need to stop all efforts at monetary and fiscal stimulus, lest we turn into Weimar, is in fact all wrong. So on that point, we are going to bring in Jim. So Jim, okay, that's Mr. Krugman's point of view.
Well,
He's saying don't panic,
This is
right?
the willful obscuring of distinctions and of nuance and argument. And this man is a Nobel Prize winner. So we're not saying that this necessarily leads to Weimar. What I am saying is that is this radical, unprecedented, indeed unimagined monetary emission is distorting the things that markets value and weigh. For example, interest rates the world over have collapsed. Now, what this does, among other things, is to take credit analysis out of the picture as a useful undertaking. Why bother to study differences in credit when everything is priced at 2 or 3%? So, and in money market mutual funds, everything is priced at 0.
Like that old Crazy Eddie commercial, right?
So,
everything is $9.99.
Right. So, because there is no profit in analyzing credit, people commit capital to the wrong places, and pretty soon you come up with a credit crisis, of which we have had many in recent memory. That's one problem with these truly radical monetary policies being followed the world over. Another problem is that they distort the meaning of money. Now, money is meant, I say, to be a store of the value of work. It is no longer that. It is a tool for the manipulation of economies. And to insist that this will work out is to ignore the massed evidence of central bank error over the preceding 5, 10, 15, 20 years. These people, well-meaning and well-educated as they are, cannot see anything coming until it hits them between the eyes.
Do you think there's any possibility that gold selling off today is caused that maybe Cyprus or some other weaker country might be looking to sell its gold reserves to try to get itself out of a hole? I mean, there's a million possibilities.
There are a million possibilities, and I think one more immediate and plausible possibility is the sheer weight of selling pressure and momentum in a market for a commodity, for a monetary medium that is, after all, without earnings, yield. Gold is a price. It is an outlook on the world. Now, the reason to be bearish on gold would be that you have utter confidence in the capacity of the central bankers of Japan, China, the United States, Europe, to dexterously manipulate those things they manipulate, to press interest rates to the floor only for so long, but not a fiscal quarter too long, and to remove everything that's excess come the moment when it should be removed. That's the bearish case on gold.
And you're saying basically there's absolutely no central banker that has this kind of crystal ball,
well,
which is a fair point.
No one has, including those of us who criticize central bankers, but certainly no central banker has proven his or her capacity to see into the future and improve it before it comes to pass, which, however, is the affect that they bring to the world.
Although, what else are they going to do, really, Jim? Right?
Do less.
Right.
What they should do, I say, is at least to give market-determined prices a chance to operate. In Japan is a perfect case study of what everybody else is doing, but higher, faster, and louder. So the Japanese Central Bank is buying real estate investment trusts. It's buying exchange-traded funds as well as bonds uncounted and unimagined. And wouldn't it be better if, instead of doing that, our central bankers would let asset prices reflect what is going on in the real economy, rather than telling us we're rich because stock prices are up, they make them go up? How about letting stock prices go up because the underlying economic activity?
Well, there's also a subsidy, right, as far as trading partners go, and this is all factoring into this decision.
And there are terrific inequities, too. Who gets the first crack at this money? Well, it's Goldman Sachs and SocGen and Citibank and all the banks that, except for the largesse of the taxpayers, would not be around telling us how lousy gold is.
What do you do, Jim, if you're an investor now? I know you're still a long-term gold liker. At least, I don't know if I can quite say gold.
I am indeed bullish on the stuff, as I say, bullish but chagrined. It seems to me that if you look around for a segment of the stock market or of the commodities markets that is truly loathed, truly out of fashion, you can't do better than gold. Okay. So if you have any contrary impulses, this is one place to begin. But I think it's the best place to begin.
Buy on sale. Jim Grant, thank you very much. Jim Grant joining us there, Grant's interest rate observer. We have a quick break to take. We are back in just 2 minutes. We're going to show you a little bit more about a hedge fund shakeout. Details coming your way. Billionaires are taking home less money, at least if they are hedge fund managers. Institutional Investors Alpha released its annual list of the 25 highest paid hedge fund managers. And don't feel too bad for them. A lot are at 10 figures. So 14.1 billion is those combined, the smallest in 4 years. So 4 managers making 10 figures. David Tepper, here's the list. On top, $2.2 billion paycheck last year. Didn't even make it into the top 25 in 2011, but there he is now. Bridgewater's Ray Dalio finishing second with $1.7 billion take home, less than half of what he took home in 2011. Embattled SAC Capital founder Steve Cohen making $1.4 billion. Followed by Renaissance Technologies, James Simons, $1.1 billion. Now, putting that in perspective, these guys are making in the range of 100 times what big Wall Street bank CEOs usually make. When we come back, we're going to take a look at one of the hottest messaging apps on the market. It is called Message Me. It launched earlier this year. In its first week, it had 1 million users. Its CEO with us next. I'm Deirdre Bolton. Welcome back to Money Moves, where we focus on alternative assets, places investors are putting their money outside of traditional stocks and bonds. We want to bring you our Bloomberg top headlines this hour. Street Smart co-anchor Adam Johnson has them from the newsroom. Adam.
Hi, Deirdre. No way to sugarcoat this one. Stocks and commodities getting absolutely hammered today, and it's happening as China's economy grows at a much slower pace than was forecast. We also got some weak economic data right here in the U.S. That Empire Manufacturing was weak. So the S&P down about 1.5%, with materials and energy companies falling the most. Commodities slumped to a 9-month low. Gold, get this, down as much as 9.7%, call it $130. That's the biggest drop since we have seen in any one day since 1980. Goldman Sachs is warning the metals retreat could accelerate after this long rally that we have seen, the longest, in fact, over 9 decades. Well, Citigroup is reporting a 30% rise in profits this quarter, beating estimates. Shares are up more than 2% today. For CEO Michael Corbat, it's his first quarter since replacing Vikram Pandit. He's been reducing staff and closing branches in a push to make Citigroup more efficient. In Venezuela, the man Hugo Chavez picked as successor won the presidential election. He is, of course, Nicolas Maduro. He's been acting as president since Chavez died last month. His margin of victory, however, we should point out, was the narrowest since 1968. His opponent is now calling for a recount. Well, Deirdre, that does it from us right here in the newsroom. Back to you on alternative assets.
Adam, thank you very much. Well, I'm going to pick up on something you mentioned, this rout in commodities. We're taking you to the CME. Alan Nuckman is with us. He is Chief Market Strategist at Option Shop. So, Alan, in your view, what is causing the sell-off in gold?
Well, I think a lot of it has to do with the electronic efficiency of the marketplace now. What's interesting is that we could digest this, and the markets are moving smoothly, if you can look at it in those terms, with this big sell-off, and the volume's about 4 times more than usual in the June gold contract. So I think this is indicative of how the markets can handle this entrance and exiting, and it's to the benefit for all traders, because you can execute a disciplined trading plan, and if you have a stop loss in place, we're not seeing gap ups or gaps down, because these markets trade essentially 24 hours. So I look at that as a positive. What happens from here, that's a big question mark. The original breakout above $1,000 back in, I think, 2009, a 50% retracement level of that to the highs puts 1450 on a weekly or maybe even a monthly basis as kind of the pivot point to watch. So it's hard to look at this on a day-by-day issue. You've got to look at it on a weekly issue to make non-emotional choices.
And Alan, just out of curiosity, I mean, I heard you say that it's an orderly market, which is good to hear, but there's a lot of people talking about the possibility that this is a liquidity event, that maybe there's a government, for example, Cyprus, that's selling some of its gold. Do you have a sense of what fundamentals might be driving the price activity?
Well, I think what was kind of pulled the plug on today, when we didn't see any bounce from Friday, we saw some follow-through selling, and then we saw, you know, the slowing Chinese numbers. So people were looking for an excuse. This is not just in gold, and gold is a leveraged product. So you got to understand the dollar move we're seeing today in gold futures, $10,000 move or $12,000 move, is almost twice of what the margin requirement is for gold. So you're dealing with someone that has to make some extreme choices because of the leverage on, you know, because of the leverage in the futures markets. But you're seeing unwinding, and it's happening more quickly now than ever before because of the advances in technology. People can make these decisions, and they can have their X orders in place, or just all of a sudden say that's enough, and that kind of feeds on itself. So gold is a very emotional market. I don't know if there's anything truly fundamental behind it, but when everybody wants to get out, they have that ability now. Whether we like it or not, it happens a lot faster, and it's seen over 2 days what typically would take weeks and weeks.
Alan, what's the next level down in your view?
1250 is pretty important. I was using 1450 on a weekly basis, but 1250 is very important. For an options trader, there are some things that are happening now that offer some good opportunities because the volatility is increased. We've seen a big jump in volatility over the past couple days, an extreme jump, and even a big jump here today as well. So that offers some option strategy possibilities as ways to play as opposed to just getting long or short, because you're going to see some big dollar moves, and who has the strength to handle all the ups and downs of the daily action? Use options with limited risk.
All right, good advice. Thank you, Alan. Alan Nuckman joining us there from the CME from Options Shop. When we come back, security expert Richard Falkenrath will be with us. There's been a deadly outbreak of bird flu in China. Some concerns as well that not all symptoms can be seen, and therefore the disease can potentially be spread more easily. Richard will be back, put the events in context for us.
First, Bloomberg.
Welcome back to Money Moves on Bloomberg Television, streaming all day long on your iPad and at Bloomberg.com as well. A strain of bird flu in China is raising concerns of a new epidemic. In fact, there have been 62 reported illnesses. 14 people have died. The strain seems to be especially serious. Symptoms have included brain damage and organ failure. Today, authorities reported that a 4-year-old boy has the disease but is not showing any symptoms, which means the disease could spread more easily and without detection. The U.S. Centers for Disease Control has activated its Emergency Operations Center to monitor the situation. For more on some of the risks that this poses, we bring in right now Richard Falkenrath. He is former Deputy Commissioner at the New York City Police Department. He served as top Homeland Security aide in the Bush administration. He is now principal at the Chertoff Group. Richard, always glad to see you, but this is pretty worrying, right? 14 people that we know about that have died so far as a result of this flu. Do we know anything about where it came from?
Well, it's native in bird populations, so it's coming from some sort of animal reservoir in China. First, it seems to have started in Shanghai. Now it's spread to Beijing. That's 750 miles, so it has the ability to spread geographically. The scary part about this is very high case fatality rate, meaning a very large number of people who get it die. Seasonal flu, which we get every winter, the case fatality rate's very, very small. This one, it's very high.
So what are the symptoms?
Well, they're just an upper respiratory infection. So you really can't tell someone who has this strain of flu from someone who has seasonal flu at the beginning. In order to find out someone who's sick, you need to take a sample from them, send it to the laboratory, have it analyzed, and that doesn't happen for many people who just get normal upper respiratory infections.
Richard, I remember when SARS broke out, we were speaking a lot. I mean, has there been any kind of evolution in the way that information is communicated, whether it's one country telling other regions in the country, or whether one country, in this case China, communicating with the rest of the world?
So yes, SARS was a debacle for China, for global public health. It is a new virus, originated in China, and the Chinese government censored social media about it and then lied to the WHO and essentially denied that the disease existed for quite a while. So it was a full-blown epidemic that then hit Hong Kong. Yeah, it was a cover-up. Hit Hong Kong with devastating effect. Then Thailand, Cambodia, reached, we thought, Vancouver. So they're doing much better now. Not perfect, but much better. They're being relatively transparent. They're doing proper epidemiology and contract tracing, and they seem to be trying to get ahead of this disease before it gets out of control.
What can the WHO do now at this juncture?
They need to monitor very closely. So something needs to happen before this is a global threat. It needs to mutate. Now, influenza mutates constantly, and it needs to mutate in a way that makes it possible for a human to give it to another human efficiently and in a way that can be passed on. If that happens with this virus, it will be something that really alters the course of history. I mean, it is a huge deal when a new, highly lethal pathogen emerges into the human ecosystem and spreads through the human population like wildfire. That's what everyone is most worried about.
Statistically, though, that's rare, right? I mean, there's bubonic plague. I mean, you have to go back, right? Spanish flu, I'm thinking about.
So the worst happened a little less than 100 years ago, 1918, the Spanish flu. It was like this. It's the single biggest demographic event in human history. It is rare, and so right now what they are doing is analyzing this virus genomically to find out if it has the characteristics that make it likely to evolve in such a way that has efficient human-human transmission.
Are there, speaking of industry, drug companies that are trying to hurry up and get a vaccine together?
So they're doing research. They've got the genotype, but it takes many years to develop a new vaccine. So H5N1, another strain of vaccine, emerged in 2003. Only in 2007 was a vaccine licensed for that. And there's one manufacturer of it. So it will take them 4 years on average to produce a new vaccine. But the drug manufacturers are looking for this, and they know, given how terrified everyone is of another pandemic, that there will be high demand from governments to buy stockpiles if they get one licensed by the FDA.
Richard, thank you as always for lending us your expertise. Richard Falkenrath joining us there with the Falkenrath Risk Report. We have a break to take. When we come back, an app called Message Me has been able to grab a big share of the competitive texting market in a very short period of time. In fact, in its first week, 1 million users alone. Has some unique features. The co-founder and CEO will be with me next. Messaging apps are the most competitive parts of the consumer app space right now. Message Me, one of the newcomers, it launched earlier this year and got 1 million users in the first week alone. So the app pre-populates your friends list rather, using your address book or through a Facebook logon. When you send messages to your friends, you can click quickly between text, photos, images, videos, music, tons of possibilities. Basically, you can amuse your buddies by putting in some ridiculous images and songs pretty quickly. So the co-founder and the CEO, Arjun Sethi, is with me now. Arjun, great to see you. Thanks for coming in.
Yeah, thanks for having me.
You said in the past that you didn't really set out to build a messaging app. That's just what ended up happening.
Sure.
So how did that happen?
Most of our background was in social gaming. And what that really meant was we spent a lot of our time thinking about communication and asynchronous communication and the way that users express themselves. And
yeah, so it was more about how people communicate, and maybe they don't always feel like writing. Maybe they want to send a few bars of a song that they know is going to make somebody crack up.
Yeah, so we wanted to make sure that we had users spend their time thinking about mediums of communication. And what that means is the way that you dress or I dress. Essentially, we were expressing ourselves. And so we wanted to make sure that when someone uses like a mobile phone and they're pushing technology forward.
But it's basically the same thing.
Not exactly. So you use your phone in a way that sort of expresses your human expression. And what that means is like music, videos, doodles. And what ends up happening is instead of just sending a text to somebody, you really focus on who you are in your intimate social network.
So I know that you have a background in social gaming. You had LOL apps. That was like 50 million monthly active users on Facebook. So how did your background in gaming help you build this?
So in gaming, there's a lot of data distribution and design. And since you have so much, you have a lot of data coming in back and forth, you're really focusing on consumer behavior. And what that sort of lent us the ability to do is take a look at, again, the way that users want to communicate and express themselves. And when we thought about moving into, again, the mobile messaging space, it takes the same type of mentality to try to figure out how users use their application, how they use messaging. Again, it's more of a social network, so communication back and forth. So what we ended up doing was just thinking about if a user is going to be like touching the screen to communicating with their loved ones, what would be those touch points? And so again, music, videos, and photos are more standard. But when you think about the context of money, when you think about the context of doodles and drawing, it's again, you're expressing yourself.
So now I know that at one point, basically people could use Message Me and be on Facebook, and it was all pretty easy. But it seems as if Facebook wanted to buy you guys. You didn't want to be bought, and then essentially they kicked you off the system. So what does that mean? I mean, did that end up giving you even more visibility, as much as of a hassle, as I imagine that was? You went and raised $2 million anyway, so it clearly didn't hurt.
Yeah, to clarify, the way that we built the application was that you could find friends that were using Message Me that were also on Facebook. So we never really tailored the product to use the Facebook graph or the Facebook data or the friends list. It was sort of a nice-to-have feature. So when they turned it off, it didn't really sort of affect our trajectory or growth. And to clarify, we've had discussions with Facebook in the past around having them join the team, but they didn't see us as a company that was building messaging at the time.
Okay, because it seems like maybe it just was too close to what they want people to do with Poke and other features, so that Facebook became uncomfortable.
It's possible they became uncomfortable. I mean, Facebook's core graph is photos. Their core milestones are photos, messaging, and their newsfeed. And so any company that works in any of those fields is, to a certain extent, competitive. So the way that they'll think about it is if something feels too intrusive, they might just take a second look, which is not the same as the way that Apple thinks about products.
Right, with Steve Jobs, as we know, legendary for working with developers. Arjun, thank you very much. Arjun Sethi joining me there, co-founder and CEO of Message Me. When we come back, Bob's buzzword of the day. We're back in just 2. Welcome back to Money Moves. Time for our daily buzzword, one investment term to improve your alt vocabulary. Bob Rice is here from Tangent Capital Partners, the Juniors. This is our focus for today. It has a lot to do with what's going on in the selling in the gold market.
Right. Everybody refers in the gold market to the juniors, and what they mean is the junior miners. And specifically, the reason they mean the junior miners is because this is the way a lot of people like to play the gold market, and there are some ETFs out there that focus solely on the juniors. So these are miners, not the big mining companies that typically are small cap companies, don't have a lot of capital, but do have a lot of gold reserves. And a lot of people who like to play gold look at them as a way of playing the gold as in a leveraged fashion as opposed to just one-on-one with the ETF.
So then how is this actually a leveraged play on gold?
Well, it's really kind of an interesting thing. So again, there are two kinds of ETFs. There are gold ETFs that actually hold the physical commodity, and then there are these ETFs that invest in companies. There are some ETFs that invest in big ones, and now these invest in juniors, the junior ETFs. So why is it leveraged as this? Is that they don't have a lot of cash, they do have a lot of gold. So if the price of gold really accelerates, then it's easier for them to raise capital and pull the gold out of the ground and sell it. Remember that it's very difficult to mine and refine gold. It's very expensive. It's very hard to do. That's why there's very little new gold in the world any given year, which is why the people who like gold as a currency substitute love it, and why people who hate gold as a currency substitute hate it.
Yeah.
And so if the price rises enough so that it goes well above the cost of production, then the stocks of these juniors will really pop. And so it gives you that leveraged effect.
Now, the ETFs with the juniors do trade with greater volatility, right, than other kinds of ETFs with other kinds of gold-ish components.
Precisely right. So these are much more volatile in general than the regular straight up, especially the commodities that are actually holding the physical gold. And a lot of guys who have gotten into this play over the last couple of weeks, therefore it tends to go up faster than the price of gold and down faster than the price of gold as well. So there's been a really big expanding discrepancy between the prices of the juniors and the price of the gold commodity. And a lot of people that I know, a lot of traders had been getting into this trade through the juniors prior to today. And today, of course, there has been a real crack in the price, giving rise to another key buzzword, Goldenfreude.
There you go.
Instead of Schadenfreude.
Right.
Because the people who hate gold bugs are taking a lot of pleasure in watching the price collapse.
I was thinking of John Paulson as one hedge fund manager that we were talking about earlier, and the past 24, 48 hours alone, he's lost $1 billion.
Yeah, and there are the people who are happy about that are enjoying Goldenfreude. But a lot of people also are speculating that he's one of the people who's liquidating and driving the price down, by the way.
Okay, but if you want to play a rebound, bottom line, the juniors is one way you can do it.
It's definitely a speculative way to do it. If you think the price of gold has gotten too far down, this is an interesting way. Now, for most people who are looking at gold, they look at it as an insurance play against inflation. The juniors aren't the right play for that. They are a speculative play, but an interesting one.
Okay, Bob Rice, we thank you as always joining us from Tangent Capital Partners. And remember, if you do have an idea for Bob's next buzzword, @BobRice3 is the way to send it in. That does do it for Money Moves. Thank you for joining us. If you missed one of the shows, you can go to our website. You can also go to our iPad app. In the meantime, Trish Regan, Adam Johnson taking you through the next 2 hours with Street Smart.